U.S. stocks ended mostly flat yesterday with no clear directional signal. The Nasdaq closed at 25,587, the S&P 500 at 7,365, and the Dow at 51,666, all with near 0% changes. But after-hours futures told a different story. Nasdaq futures dropped 0.33%, S&P futures edged down 0.08%, and only Dow futures managed a tiny 0.03% gain. Big tech names were broadly weaker. QQQ fell 0.33% to $713.65. Nvidia dropped 0.43% to $200.04. Tesla slipped 0.22% to $381.61. The market is now in a phase of repricing macro risks, and weaker futures suggest pressure will remain when U.S. markets open tonight. Looking at the global macro picture, the 10-year U.S. Treasury yield fell 1.31% to 4.43%. This is the latest in a series of declines, reflecting capital flowing into safe haven assets as risk appetite drops. It is not a sign of liquidity easing but rather the combined effect of demand concerns and risk aversion. The VIX Volatility Index stood at 19.04. It fell 2.31% in a single day but has risen 13.5% over the past 7 days. Market expectations for increased volatility are clearly building. The U.S. dollar index strengthened to 101.78, rising 0.92% in a week and moving back above 101.5. This puts pressure on emerging market assets and is directly linked to gold breaking below the $4,000 level. WTI crude oil plunged 3.04% to $70.43, with a 7-day cumulative drop of nearly 8%. Saudi Arabia's production cut is being interpreted by the market as confirmation of weak demand, weighing on the energy sector. Spot gold fell 2.17% to $3,995, breaking below the psychologically important $4,000 mark. This is one of the clearest risk signals we have today. The global market is now in risk-off mode, driven by the combination of demand concerns and a stronger dollar. The condition for this to reverse would be the VIX falling back below 17 and Nasdaq futures turning positive. Turning to the renminbi and China's external environment, the dollar is trading at 6.8002 against the onshore yuan and 6.8183 against the offshore yuan. The onshore yuan has weakened 0.52% over the past 7 days, while the offshore yuan slipped 0.18% today. Overall depreciation pressure is moderate, but if the dollar continues to strengthen, it will increase pressure on the offshore yuan and could dampen northbound capital flows. On the trade and tech front, the U.S. Bureau of Industry and Security added 7 Chinese entities to its entity list, targeting quantum computing and semiconductor equipment. The U.S. Trade Representative has also completed public consultation on raising tariffs on Chinese new energy vehicles, lithium batteries, and photovoltaic products, with some categories expected to see rates increase to 100%. In response, China's Ministry of Commerce announced today that it will review export controls on gallium and germanium-related items. These developments mean U.S.-China tensions are escalating, creating both structural pressure and opportunities for related A-share stocks. For today's A-share market open, we expect a flat start. Weak overseas futures and spreading risk aversion will weigh on the open, but yesterday's A-share market showed resilience with the Shanghai Composite closing in positive territory. Domestic policy expectations still provide some support, so a sharp gap down is unlikely. However, if northbound capital net sells exceed 20 billion yuan within the first 30 minutes of trading, the risk of a lower open increases. For today's A-share market specifically, the Shanghai Composite is likely to consolidate, while the Chi-Next board may continue to outperform the main board. The Shanghai Composite is expected to trade around the 4,100 level. If the Chi-Next holds above 4,200, a structural rally is possible. The most active sectors today are likely to be defense and countermeasure concepts, along with utilities. There are 3 reasons. First, The new entity list and tariff escalation expectations directly strengthen the logic for semiconductor equipment self-sufficiency and rare earth countermeasures. Second, in a risk-off global environment, utilities as a traditional defensive sector attract capital. Third, these two sectors were already validated as safe havens in yesterday's analysis. Sectors to avoid include energy, dragged down by the crude oil plunge, and precious metals, under pressure from gold's breakdown. Gold falling below $4,000 will trigger technical selling, putting near-term pressure on related stocks. Northbound capital is more likely to see net outflows than inflows today, as a stronger dollar and rising risk aversion typically drive foreign capital out of emerging markets. The key signal to watch is northbound capital flow in the first hour of trading. If net selling narrows or turns positive, market sentiment could exceed expectations. Here is our core judgment for today. The dollar is strong, oil prices are falling, and gold has broken support. The global risk-off mode is engaged. For A shares, the focus should be on structural defense, specifically defense and countermeasure sectors along with utilities.